Welcome to Lit Capital's Pip Talk podcast. I'm your host, Cavell, and I hope you're all well. Today marks our first ever podcast, so if you find this video useful, let us know by giving a like and also dropping a comment below. Now, Pip Talk podcast will bring you fundamental updates every week and weekly market reviews without fail. So to start things off, we go over the latest Nfp result, and for those who don't know, NFP does stand for non-farm payroll. Now, the results beat the analyst forecast and increased to 225,000 in January, which is up from 147,000 in December last year. The unemployment rate is also slightly up to 3.6%, which is up from 3.5%. However, that is still right around multi-decade level lows and down almost half a percentage point from a year ago. So there is little reason for monetary policymakers to consider rate cuts at the moment, and we can continue to see the Fed really sit on the sidelines and monitor what's going on before they make any drastic measures. Moving on to the US outlook, Trump's impeachment seems to be over, which towards the start of the week gave the market confidence by the Dow Jones making a new all-time high. And if you've also paid attention to the DXY, it's up for the fifth consecutive day, trading at its highest since October last year. Now, towards the latter end of the week, with NFP being released and further developments from the coronavirus in China, this has presented a new risk to the US outlook, as you could believe. Financial sectors are appearing low by historical averages, which will decrease their leverage and may give us a bearish outlook sometime soon. Moving on to the Asian outlook, over 100,000 people, unfortunately, in Asia have been affected with the coronavirus, and the measures taken to control the outbreak has hurt a list of companies and will continue to do so. Now, the global impact will be felt massively through four major economy channels: tourism revenues, exports of consumer and capital goods, commodity prices, along with industrial supply chains. All of these will be affected, which should see some exotic pairs weaken, also along with the yen. Now, as you could imagine, with China exporting to nearly every country in the world, these spillovers could become larger if markets start to price in the risk of a material global slowdown and financial conditions tighten due to the risk level rising across asset classes. As you guys could imagine, there's probably not a single item in your household that's not from China. So you could imagine from the manufacturing companies right down to the exporting companies, a lot of business is going to be slowed down, which can, of course, affect markets globally. Last year, 2019, the Chinese economy grew by 6.1%. That does sound like a good number, but it's actually the lowest since 1990. And with all that's going on right now, we can expect to see numbers sadly reduce. So for all you stock traders out there, shorting companies like Burberry, who have a big Chinese audience, will make a lot of sense, if not pips. See what I've done there? And lastly, onto the European outlook. Germany, which is Europe's largest economy, is facing a possible recession again after industrial production fell the most since the global financial crisis. For those of you who remember when David Cameron was our Prime Minister, he did mention he wanted to move the UK out of the EU because a red light was flashing on the dashboard of not just the global economy, but a red light flashing within the Eurozone for a possible recession. So it seems like we may have got out just in time, but only time will tell. The 3.5% slide in December's output comes a day after a report showed factory orders declining at the fastest pace in more than a decade. That suggests Europe's largest economy may have declined at the end of last year, and dragging itself out of the hole this year has become even more challenging with the coronavirus hitting global business. Germany has been swamped by trade tensions, Brexit, and the climate challenges engulfing its auto industry. Companies like Volkswagen, for etc., are under a lot of strain at the moment, of course, having to adapt to renewable energies, but of course making sure they can minimize their pollution, which of course is affecting our climate change. The most recent data will decrease the level of optimism that it can recover soon. So from an investor's point of view, the euro as a whole is not looking too appealing. And there was further bad news for Europe on Friday, as France reported a 2.8% drop in industrial output in December, and Spain posted a 1.4% decline also. Both readings were far worse than economists had anticipated. The Netherlands added to the gloom, with manufacturing shrinking by 1.7%, the most since 2018. Now, the euro has fallen and also closed at its weakest since 2019 in October. So the GDP figures for the whole European economy are due next week, and a contraction could prompt renewed calls for fiscal stimulus. Now, for those of you who don't know what fiscal stimulus is, during the periods of economic turbulence, the government and central banks, of a country can try to stimulate the economy. Central banks do this by lowering interest rates in order to make it cheaper to borrow money on one hand, and on the other hand, they can directly inject money into the system through monetary easing, which is also known as quantitative easing. So the government has many different tools at its disposal. I'm not going to go into a list of them, but on one hand, it can encourage the private sector to become more active by lowering taxes. And on the other hand, it can increase public spending so as to compensate for the lack of private sector demand. This is for the most part how the central bank and government of a country can try to stimulate the economy. But the main question is, should they? Should economists intervene? Some economists believe the state should intervene in the economy whether there is a crisis, because they don't think the market is capable of rebounding properly, whereas other economists believe the complete opposite. And that's because the pain that is inflicted upon the economy by a financial crisis is bitter but necessary medicine, and that the state should stay out because its involvement does more harm than good. If we recall the last recession we had, each recession we've had, we've been told that there won't be one worse than what we've currently gone through. And each recession we've had has been the complete opposite to what they've said. So, what seems like the unspoken truth is that economists don't yet know what needs to be done after a crisis. And for that reason, it is important you educate yourself on how financial markets work and how they can work for you. That's it from us today at Lit Capital. I've been your host, Cavell. Don't forget to like this podcast if you've enjoyed listening, and subscribe to our channel to keep informed and up to date in the financial markets. I hope you've enjoyed listening and have gained some knowledge along the way, because every day truly is money day.